Look, in my last video, I walked you through the silver daily chart. I marked the February 6th candle as key support. I explained the swing failure pattern, and I laid out the 72.6 to 70 zone as the primary support area. I told you clearly, if price held that zone and we got displacement, we could see 75 first, then 77. Silver is now trading around 75.5. Price bounced exactly from that support, exactly as mapped. Now here's the part most people won't like. Most of you won't finish this video. You'll click away the moment I show you something that challenges what you want to believe. And that's fine. This channel isn't for most people. It's for the ones who would rather be correct than comfortable. The ones who check sources before forming opinions. The ones who understand the difference between data and narrative. If that's not you, there are 10,000 other finance channels that will tell you exactly what you want to hear. I'm John Agye. You can find me on X and YouTube. Focus on the handle, not the name. Names get copied. Handles don't. The people who belong here are the ones in the comments adding sources I didn't cover and pointing out what matters. That's the standard. You either operate there or you don't last. Subscribe if you want more. Don't if you don't. Either way, I'm not asking. Now, let's get into the real update. Today is FOMC minutes day. That is a volatility window. Silver in the West is around 75 spot and 75 futures. In Shanghai, silver is around 86 spot and 88 futures. That's an $11 premium east to west. Gold in the West is around 4,930. The FOMC minutes release at 2 p.m. Eastern today. That is a high-impact event. Expect volatility around that window. The economic calendar tells you exactly when manipulation is most likely for tape reading purposes. Now let's talk levels, because right now, only a few levels matter. On the lower time frames, structure still looks healthy. If buying pressure continues, the upside objectives are 77 first, then 78.2. These are the areas where price can move if momentum stays intact. On the downside, the immediate support sits between 74.8 and 73.9. I do not want to see body closures below that range. Wicks touching that zone are acceptable. That's just the market testing liquidity. But bodies closing below 73.9 signal weakness, and it suggests the bounce may be failing. And remember, that February 6th candle remains our anchor. We do not want body closures near the proximity of its wick. Touching the wick is acceptable, but bodies closing there is a warning sign. If we start seeing bodies closing below the 72.6 to 70 support zone, then we can reasonably expect lower prices, down to 67 or even below that February 6th wick. With the FOMC minutes coming out at 2 p.m., you need to be prepared for both scenarios. This is not a time for guessing. This is a time for watching how price reacts to the news. Let the market tell you its story. Read the tape. Watch volume. Wait for confirmation. If you need a refresher on the levels, go back and watch my previous video. And as always, this analysis is for educational purposes, specifically for short-term traders who have been asking me to cover this material. Now here's what broke overnight. The U.S. has developed a critical minerals price floor system, and it is actively pitching it to allies. The goal is simple: reduce dependence on China for resources deemed critical to national security. Multiple agencies built a sophisticated price floor mechanism, and officials have confirmed that conversations are already ongoing with allies and partners. And here's the key point. Pricing is the thing that unlocks private investment, because nobody invests billions into mining capacity if the paper market can crush prices below production cost anytime it wants. According to official statements, gold and silver surged on this news. Gold up around $90, pushing into the 49.56 area. Silver up over $3, moving into the 75 range. This is the mid-reveal that changes the entire framework. A price floor system for critical minerals, including silver, means government-backed minimum prices regardless of paper market manipulation. This isn't theoretical anymore. This is policy being pitched to allies as we speak. And when governments guarantee floor prices for strategic commodities, the paper market loses its primary weapon. The ability to crash prices below production costs, shake out weak hands, and maintain artificial scarcity narratives. Now layer on top of that what Ray Dalio has been warning. Dalio has been clear. Escalating trade tensions and growing fiscal deficits could undermine confidence in U.S. debt. And when confidence in debt breaks, investors move toward hard assets, gold especially, because he views it as an essential hedge. That matters, because Dalio isn't a retail influencer. He's someone who managed institutional capital at scale. The people who read primary sources already know his framework on debt cycles and currency debasement. His shift toward hard assets being essential rather than optional signals a change in institutional positioning at the highest levels. Now let's talk about COMEX, because COMEX supply stress is accelerating. COMEX registered silver has dropped to around 92.2 million ounces. March open interest sits near 285.3 million ounces. Do the math. That's roughly 193 million ounces more paper than deliverable metal. Last Friday, almost 5 million ounces were pulled from COMEX vaults, and about 800,000 ounces shifted from registered to eligible. Total registered is now around 92 million ounces available to settle futures contracts. The withdrawals are accelerating, not slowing. Now here's what the roll mechanics show. March open interest only fell around 7.6 million ounces, from 293.9 million down to 285.3 million. At this stage, the roll needs to accelerate massively to ensure sufficient silver for March delivery. Open interest would need to fall roughly 30 million ounces per day. That's not happening. The curve keeps tightening daily. The March to May spread is negative 52. But after financing, storage, and insurance, the carry-adjusted contango is only 4.9. That means the market is paying almost nothing to push demand out to May. And if the market isn't paying you to roll, there's no incentive to roll, which means upward pressure on the March contract is building every single day. Now everything is screaming the same message. Silver price needs to move higher to bring this market back into balance. And we have about 8 days remaining until March settlement begins. The data is publicly available. CME posts it daily. The ones who verify already pulled the numbers and reached the same conclusion independently. Now let's talk mining, because mining profits expose the paper lie. Hecla Mining just released results. Revenue exceeded $1.4 billion, up 53% from 2024. Net income reached $321.2 million, a ninefold increase year over year. Silver production totaled 17 million ounces at the high end of guidance. The company generated strong cash flow, reduced total debt by 50% down to $276 million, and net debt dropped to just $34 million. All operations were free cash flow positive. This is what happens when silver prices reflect actual supply and demand fundamentals instead of paper suppression. Mining companies that were barely surviving at artificially suppressed prices suddenly show record profitability when prices move toward reality. Jim Rickards wrote about this years ago in Currency Wars. He explained how commodities become weaponized during geopolitical realignment. Nations secure supply chains not just for profit, but for strategic independence. What we're seeing with the U.S. critical minerals price floor fits that framework perfectly. This isn't free market economics. This is financial warfare. Strategic resources get guaranteed government backing because the alternative is dependence on adversarial powers. The people who read that book a decade ago recognized this phase was inevitable once U.S.-China decoupling accelerated. Now at another layer. Reports are coming out that the Trump administration has moved closer to a major war with Iran. Breaking reports suggest officials warned it would not be a limited strike, but a large-scale, weeks-long war if launched. Peace talks continue, but major gaps remain. Washington is rapidly building military presence across the Middle East: carriers, warships, fighter jets, and weapons deployments. Some insiders say military action could begin within weeks if diplomacy collapses. And remember this: 20% of global oil flows through the Strait of Hormuz. A weeks-long conflict there doesn't just move oil prices. It disrupts global manufacturing supply chains that depend on Middle Eastern energy, and that directly impacts industrial silver demand, which is already in its sixth consecutive year of structural deficit. Now let's zoom out. Mining stocks versus global equities are sitting at a six-decade low. From 1900 to 1965, mining averaged around 8% of global equities. During 1955 to 1965, it peaked near 10%. Today, it sits at just 1%. That is historic underweight. For mining shares to merely return to their long-term average, they would need to rise 8 times relative to global equities. Reaching the historical peak would require 10 times. Governments are reshoring industry. They're rebuilding supply chains. They're prioritizing energy security. And none of that happens without metals and fuel. Mining and energy are moving from cyclical sectors to strategic necessities. Capital allocation shifts from maximizing margins to guaranteeing supply, regardless of cost. Charles Mackay wrote Extraordinary Popular Delusions and the Madness of Crowds, documenting how markets swing between extreme undervaluation and extreme overvaluation as crowd psychology shift from fear to greed and back. Mining at 1% of global equities while governments implement price floors for critical minerals represents the fear extreme. Maximum pessimism, precisely when fundamentals are shifting toward a multi-year bull market. The majority always positions at exactly the wrong time because they respond to price rather than understanding structural shifts happening beneath the surface. Now here's another major piece. Gold miners versus the S&P are about to break out of a decade-old range, according to technical analysis. In 2011, gold miners versus the S&P were 3 times higher than current levels. But this gold cycle is different. Central banks are net buyers. Trust in the U.S. and the dollar is at record lows. Analysts expect this gold bull market to resemble the 1970s, when miners massively outperformed the broader market as inflation and currency debasement drove capital into hard assets and the companies that produce them. Now, the bearish case still matters. FOMC minutes at 2 p.m. could trigger volatility that breaks technical support. Iran war rhetoric could de-escalate through diplomacy, removing the geopolitical premium. The critical minerals price floor is still in the discussion phase with allies, not implemented policy yet. March open interest could accelerate the roll in the final week, as it has in past cycles. COMEX registered at 92 million is still technically sufficient if the historical 5% delivery average holds. Mining stocks' historic underweight could persist if institutional capital stays in tech and AI rather than rotating into commodities. This is financial warfare education, not investment advice. But the complete data picture is now clear. The U.S. is implementing a strategic price floor for critical minerals with government backing. COMEX registered is down to around 92.2 million ounces. Open interest is still around 285 million ounces, not rolled, just 10 days before settlement. Roll pace only dropped about 7.6 million when it needs to drop 30 million per day. Carry-adjusted contango is only 4.9. There is no incentive to roll. Hecla mining net income is up 9 times, showing what happens when prices reflect reality. Mining stocks are at 1% of global equities versus 8% historical average. Gold miners are breaking a decade-old range. Iran conflict risk is building, with a weeks-long war possible. Ray Dalio is pointing institutional capital toward hard assets as an essential hedge. And silver held the 72.6 to 70 support zone exactly as mapped, then moved to 75.5. Now here's what matters. Technical levels are playing out as forecasted, giving traders a framework to navigate volatility. Fundamental supply-demand crisis at COMEX is intensifying, not resolving. The U.S. government is implementing strategic commodity policy that changes the game for critical minerals, including silver. Geopolitical risk is escalating in a region that controls 20% of global oil supply. Mining is at historic underweight, while governments prioritize supply chain security. And FOMC minutes at 2 p.m. today provides the catalyst for the next directional move. The informed minority understands something the majority misses. Price is information, but it's not always accurate information. When paper markets manipulate prices below production costs for years, the eventual correction doesn't happen gradually. It happens violently. It happens when physical reality overwhelms paper fiction. And the ones prepared are the ones positioned early, before that recognition becomes consensus. Invest with logic, not hype. OG out and about.